You want to see how useful trust can be? If you want a tax smart way to protect your assets from future partners, this is one of the ways that you can do it. Now, Miss Smart here has accumulated lots of wealth before she meets Mr. Less Money. And she's thinking, well, I don't know what the future holds. We love each other now. We might get divorced later. This is the money that I had before we met. And I want to protect this. I want to preserve it. And this is one of the ways. So here we've got Miss Smart, and we want to put this money into a trust for her. But she cannot be the trustee of that trust for a couple of reasons. If she has got control over it, it could be called into form part of the marital assets. So what we will do is we form a limited company, which, by the way, will have no value, will have like a $1 share, and its only job is to administer this trust. And since she is the only shareholder of this company, it will indirectly control this trust. Now let me get rid of all these arrows. So we formed the limited company, and now we're going to move all that money into the trust here. Now the trust has got this money sitting in the bank account and decides to go and buy some property. And the properties are producing rental income. Now this trust, it can't just have the money sitting in there, otherwise it will pay 47% tax, which is not desirable. So we've also created a bucket company here, and its only shareholder is the trust, which means, and it's also a beneficiary of the trust, which means the money can flow both ways. The trust can distribute money into the bucket company, and the bucket company can pay dividends into this trust. Again, let me get rid of the squiggly things. Now, the reason we want to distribute to the company and not leave it in the trust, as I said, the trust pays 47% tax, whereas the company pays between 25 and 30% tax, which is far more desirable. And in the future, if we need money from the company, it can either pay dividends into the trust, or we can borrow money from the limited company, from all the money that's accumulated, and purchase more properties in the trust. So this trust here is a good vehicle for growing your wealth. Now, it's all good and well to accumulate wealth here, but at some point you will think, well, actually, I want to be able to access that money, and I want to be able to use it for my family. So Mr. and Mrs. Smart have gotten married, and they've got 2 children, and Miss Smart wants to contribute some more into the family income. She could do that via this other little trust that is sitting here. Is called the Little Family Trust, and it can distribute money to Miss Smart. It can even distribute money to Mr. Less Money, and it can distribute money to the children under certain circumstances. But we will leave that for another time. Let me get rid of the squiggly lines again. While this structure allows you to pull money out and distribute it to the family, what it does do, it will preserve the assets in this structure without it being part of the marital assets. And it's protected here. If you get divorced or separated, you can take all the money that you have accumulated here and all the assets that you've put into this structure and take it with you and go your own way. So this is how to be tax smart and money smart.